Everyone thinks this is an AI story. It is not. It is a token story. And there are actually two token revolutions happening at the same time. The first is obvious: AI tokens. Every prompt, every answer, every line of code, every chatbot response, every autonomous agent task, underneath it all, AI is processing tokens. But the second revolution may be just as important: asset tokens. Stocks, bonds, funds, real estate, private credit. Wall Street is beginning to explore how ownership itself can be turned into digital tokens. One token revolution is changing how work gets done. The other is changing how ownership moves, and almost nobody is connecting both. In episode 1, we looked at NVIDIA's $119 billion capacity bet. Today, we ask the bigger question: what exactly is all that capacity going to process? For centuries, capitalism was measured in labor's hours, factories, machines, and physical output. Then the internet shifted the measurement toward data: clicks, searches, gigabytes, and cloud workloads. Now AI is shifting the unit again. In the AI economy, the basic unit of work is the token. And if tokens become the new unit of economic activity, then the companies that manufacture, distribute, and process tokens may become part of the operating system of the future economy. Welcome back to SkiesCapital. I'm Captain Pierce. Think clearly, invest better. This is episode 2 of the Token Economy series, Tokenomics, the new rules of global capitalism. Let's go. Before we move into episode 2, let's quickly recap the flight path from episode 1. First, NVIDIA hit real geopolitical turbulence. The H-20 export restriction turned China exposure into a financial hit. NVIDIA took a $4.5 billion charge, and gross margin dropped to 60.5%. That was the warning light. Second, the business came roaring back. NVIDIA's demand signal did not weaken. It got stronger. Revenue reached $81.6 billion, up 85% year over year. That told us something important. The China risk was real, but the broader AI demand curve was still extremely powerful. And third, we looked at the big number hiding in plain sight: $119 billion in supply and capacity commitments. That is not a small operating decision. That is a massive bet on future demand. So this is where episode 2 begins. NVIDIA is not just betting on chips. It is betting that the next economy will require enormous amounts of processing capacity. And what is all that capacity processing? Increasingly, it is tokens. Now let's zoom out and look at the bigger pattern. Every major economic era has had a core productivity unit, and the companies that controlled that unit usually controlled a major part of the economy. In the industrial age, the unit was the labor hour. Factories measured output by workers, machines, shifts, and hours worked. Productivity meant producing more physical goods with fewer labor hours. Economic power belonged to the companies that controlled the factory floor. Then the internet changed the measurement system. The unit shifted toward data, storage, bandwidth, gigabytes, clicks, searches, and cloud workloads. The companies that controlled digital infrastructure became some of the most valuable businesses in the world. Then came the AI training era. The unit shifted again, this time toward compute. Investors started talking about GPUs, data centers, training clusters, and flops. In plain English, flops measure how much mathematical work a computer can perform. More compute meant more powerful AI models. But now we are moving into the next phase. The unit is becoming the token. A token is the basic unit an AI system reads, processes, and generates. Every prompt, every answer, every line of code, every image request, every video model, every AI agent task, underneath it all, the system is processing tokens. That changes the investment question. It is no longer just who has the most GPUs. The deeper question becomes who can process the most intelligence at the lowest cost at the largest scale. That is why the token matters. If the labor hour powered the factory economy and the gigabyte powered the internet economy, the token may power the AI economy. Now let's make this simple. A token is the fuel AI uses to do work. Think of tokens like electricity for the AI age. Technically, a token is a small unit of text, often about 4 characters or roughly 3/4 of a word in English. But for investors, the exact definition is less important than the economic meaning. Every time AI reads something, writes something, checks something, or produces an answer, it is consuming tokens. At first, Most people experienced AI as a simple chatbot. You ask one question, it gives one answer, and the job is done. That might use a relatively small number of tokens, but AI is now moving from answers to work. The next step is when AI helps complete an actual business task. For example, a logistics AI can check weather, compare shipping routes, review inventory, draft a supply chain report, and recommend the best plan. That is no longer just a chat. That is a business workflow. Then comes the bigger jump, AI that keeps working in the background until the job is done. Some people call this agentic AI. I like to think of it as an AI worker. It can loop through information, check its own work, run simulations, update the output, and keep moving toward a goal. That is why token consumption can scale so quickly. A simple chat might use around 1,000 tokens. A full business task might use around 100,000 tokens. And an autonomous AI workflow could use 1 million tokens or more. So the key idea is this: the more useful AI becomes, the more electricity it uses. And in the AI economy, that electricity is tokens. That is why tokens matter. They are not just a technical detail. They are becoming the fuel gauge for AI-powered business work. Now let's put some scale around this. Goldman Sachs research projects that AI token consumption could rise 24 times by 2030, reaching roughly 120 quadrillion tokens per month. That is almost impossible to picture. 120 quadrillion is 120 followed by 15 zeros, but the exact number is not the most important point. The important point is the direction of travel. Token demand could explode as AI moves from simple chat to real business work. There are 4 reasons this matters. First, the AI work multiplier. One prompt no longer means one answer. A single request can trigger background steps: reading files, checking data, drafting output, running calculations, reviewing the answer, and trying again. That means one human instruction can create thousands or even millions of tokens behind the scenes. Second, the business adoption wave. Companies are moving AI from experiments into real workflows: customer service, coding, finance, logistics, and operations. That turns AI from a demo into a daily operating tool. Third, sovereign AI build-out. Countries want their own AI infrastructure. They do not want to rely entirely on foreign platforms for a technology this important. That adds another layer of demand beyond corporations. And fourth, always-on AI usage. Training a model happens in bursts, but using AI happens continuously. Every question, every task, every workflow, and every agent run burns tokens. So here is the simple way to think about it. If tokens are the electricity of AI, then agentic AI is like turning on millions of new machines at the same time. That is why the 120 quadrillion number matters. It is not just a big forecast, it is a signal that AI may be shifting from occasional use to continuous economic activity. Now we get to the metric shift. For years, AI performance was mostly discussed in technical language. One of the classic measurements was flops, floating point operations per second. In plain English, flops measures raw computer speed. It tells you how much mathematical work a system can perform. That still matters. Engineers care about flops, and they should. But flops does not answer the business question. A CFO does not just want to know how fast the machine is. A CFO wants to know, how much does it cost to serve a customer? How much does it cost to run a workflow? How much does it cost to generate useful AI output? That is why the language is shifting from speed to economics. NVIDIA is pushing this idea hard. Data centers are no longer just compute warehouses. They are becoming token factories. And once you think of them as token factories, the key question becomes simple. How many useful tokens can this factory produce, and at what cost? That is where cost per million tokens comes in. Think of cost per million tokens as the price of producing useful AI output. It connects the technical side of AI to the business side. It helps investors and CFOs compare systems not only by how powerful they are, but by how efficiently they turn chips, electricity, networking, cooling, and software into business value. This matters because the AI winners may not simply be the companies with the most GPUs. The winners may be the companies that can produce the most useful tokens at the lowest cost, at the largest scale, with the best reliability. So flops still matter. But for Wall Street, flops are no longer enough. The new instrument on the panel is cost per million tokens. Now we get to the Blackwell inflection point. This is where the token economy starts to become economically viable for the enterprise. NVIDIA's comparison between Hopper H200 and Blackwell GB300 shows just how dramatic the change is. Token output per second goes from about 90 to 6,000. Tokens per megawatt go from roughly 54,000 to 2.8 million. And the cost per million tokens falls from about $4.20 to 12 cents. That is roughly a 35 times reduction in cost per million tokens in one architecture generation. And that matters because enterprise AI is not just about whether the technology works. It is about whether the economics work. At $4.20 per million tokens, a company has to be careful. Every workflow, every agent loop, every background process has a cost attached to it. AI may be useful, but budgets can limit how broadly it gets deployed. At 12 cents per million tokens, the conversation changes. Many workflows that were too expensive to run continuously start to become economically scalable. Customer service, coding assistance, finance workflows, logistics optimization, claims processing, compliance review. The use cases expand when the cost of AI output collapses. That is why I think of Blackwell as more than just a faster chip. It is a cost collapse event. It changes the unit economics of enterprise AI. And that brings us back to the core thesis. If tokens are the electricity of AI, then Blackwell lowers the cost of that electricity. It allows more AI work to be done more often across more parts of the business. So the winners in AI infrastructure may not simply be the companies with the most compute. The winners may be the companies that can produce useful tokens at the lowest cost, at the largest scale, with the best reliability. Now, we get to the part that I think most investors are missing. There are actually two token revolutions happening at the same time. Most people understand one of them. Very few are connecting both. The first revolution is AI tokens. These are the tokens we have been talking about throughout this episode. The units AI systems use to read, think, generate, and complete work. These tokens are produced and processed by the AI infrastructure stack: NVIDIA, AMD, Microsoft, Google, Amazon, OpenAI, Anthropic, and the enterprise AI platforms that sit on top of them. AI tokens power answers, coding assistance, enterprise workflows, autonomous agents, and 24/7 inference. And the scale is enormous. Goldman Sachs projects roughly 120 quadrillion AI tokens per month by 2030. So, on this side of the economy, AI tokens become a new operating cost for businesses, almost like electricity, cloud spending, or headcount. But there is a second revolution happening at the same time: asset tokenization. This is where financial assets, stocks, bonds, funds, real estate, private credit, and commodities can be represented digitally. BlackRock, JP Morgan, Goldman Sachs, and other major financial institutions are all moving in this direction. That matters because tokenized assets could change how ownership moves through the financial system. Markets can move closer to 24/7 access. Settlement can become faster. Fractional ownership can make some assets easier to access. And programmable compliance can make certain processes more automated. Now, to be clear, this does not mean the old financial system disappears overnight. Custody, compliance, regulation, security, and identity still matter, but some of the friction can get compressed. Settlement delays, paperwork, transfer agent friction, and legacy infrastructure costs. So here is the big idea. AI tokens measure digital work. Asset tokens digitize ownership. One changes the cost of producing intelligence. The other changes the way capital moves. And if both are happening at the same time, then the token economy is not just an AI story, and it is not just a crypto story. It is a much bigger shift in how work and ownership are measured, processed, and monetized. Now let's shift to the Wall Street side of the token economy. Larry Fink, the CEO of BlackRock, has been very direct about where he thinks this is going. His view is that every stock, every bond, every fund, every asset can eventually be tokenized. That is a big statement coming from the head of the world's largest asset manager, with nearly $14 trillion in assets under management. And Fink has compared this moment to the internet in 1996. That is important. In 1996, the internet was no longer just a science project, but most investors still did not understand how much of the economy it would eventually reshape. Fink is arguing that tokenization may be at a similar stage. The first proof point is BlackRock's Boodle Fund. This is a tokenized U.S. Treasury and liquidity fund launched on Ethereum. It is not a meme coin. It is not a speculative crypto trade, It is a major institution putting a real-world financial asset on chain. That matters because treasury funds are one of the cleanest starting points for tokenization. They are liquid, transparent, yield-bearing, and easy for institutions to understand. If that model works, the same logic can eventually extend into other areas: funds, bonds, private credit, real estate, and infrastructure. The second idea is fractional ownership. Tokenization can potentially lower minimum investment sizes and make assets more accessible. Markets that once required large checks may eventually be divided into smaller digital ownership units. The third piece is regulation. The approval of spot Bitcoin ETFs, growing tokenization guidance, and the Genius Act stablecoin framework are all giving institutions more confidence to build on-chain financial rails. Now, this does not mean the entire financial system moves on-chain overnight. That is not how regulated markets work. Custody, compliance, investor protection, and settlement rules still matter, but the direction is becoming clear. Wall Street is no longer treating tokenization as a side experiment. The largest institutions are beginning to test it, build around it, and prepare for a financial system where ownership itself can move more like software. Now let's talk about what tokenization actually changes. The headline is not that every middleman disappears overnight. That is too simple, and in regulated finance, it is not realistic. The better way to think about it is this. Tokenization compresses manual friction. It makes ownership, settlement, compliance, and administration more digital, more programmable, and potentially much faster. Start with settlement and clearing. The United States has already moved from T+2 to T+1 settlement for many securities. That is progress. But even at T+1, the system still depends on clearing, custody, reconciliation, and settlement infrastructure. Tokenized rails could move parts of that process closer to near instant settlement and 24/7 transfer. That does not eliminate every risk, but it can reduce delays, trapped capital, and operational friction. Second is ownership access. Many private market assets, private credit, real estate, infrastructure, and private equity have historically required large minimum investments, investor eligibility, and complex administration. Tokenization can divide ownership into smaller digital units. That could lower minimums and widen access where regulation allows. Third is paperwork and compliance. Today, financial assets still require layers of documentation, fund administration, transfer records, NAV calculations, corporate actions, and compliance reporting. Smart contracts and digital ledgers can automate parts of that process: payments, ownership records, corporate actions, and reporting. But again, this does not mean humans disappear. In aviation terms, automation does not eliminate the pilot. It changes the workload. It moves people from manual execution to oversight, exceptions, risk management, and governance. That is the investment point. Tokenization may not remove every middleman, but it can compress the friction that many middlemen were built around. And when friction gets compressed, new economics appear. Faster settlement, lower minimums, more programmable ownership, better transparency, and potentially new platforms that sit at the center of the system. So let's bring this episode into final approach. The token economy is not one story. It is two stories happening at the same time. On one side, AI tokens are becoming the fuel for digital work. Every prompt, every answer, every code assist, every business workflow, and every autonomous agent task consumes tokens. NVIDIA's Blackwell architecture matters because it lowers the cost of producing those tokens. And Goldman Sachs' forecast of 120 quadrillion tokens per month by 2030 gives us a sense of how large this demand curve could become. On the other side, asset tokens are beginning to digitize ownership. Larry Fink has said that every stock, every bond, every fund, every asset can be tokenized. BlackRock's Bivital Fund is one early institutional proof point that real-world financial assets can move on-chain. This is not just a crypto experiment anymore. Wall Street is building around it. The common thread is friction. In AI, tokens compress the friction of work. They let machines read, reason, write, code, calculate, and execute faster than traditional human workflows. In finance, tokenized assets can compress the friction of ownership. They can potentially speed settlement, lower minimums, automate administration, and make ownership more programmable. That is why this matters. The companies that produce, distribute, and process tokens may become part of the operating system of the next economic era. For investors, the question is not just whether AI grows, and it is not just whether tokenized finance grows. The deeper question is whether your portfolio is exposed to both sides of the token economy. NVIDIA sits near the manufacturing layer. Microsoft, Google, and Amazon sit near the cloud and distribution layer. BlackRock sits near the asset tokenization layer, and the companies that connect these systems to real business outcomes may become some of the most important infrastructure companies of the next decade. That is the thesis of Episode 2. AI tokens measure work. Asset tokens digitize ownership, and both revolutions are happening at the same time. If you found this helpful, please like and subscribe. It genuinely helps the channel reach more long-term investors who are trying to think clearly about the companies they own. In Episode 3, we are going to ask the next question: who is actually buying these tokens at scale? And why might Google's $500 billion backlog be one of the biggest clues investors are missing? This has been Captain Pierce with SkiesCapital. Think clearly. Invest better for educational purposes only, not investment advice. Keep the blue side up. Safe skies. I'll see you in Episode 3.